Hello and welcome to today's presentation on how to read financial statements. I'm your host, Ray Langley. Bit of a legal disclaimer, every company is different and their situations are different as well. Therefore, not every financial statement will be the same. For today's lesson, we're going to use an example company. Our name is Catching Rays Solar Inc. We collect commissions from the sale of solar panel lease contracts that are installed and serviced by Sunny Day Solar Equipment. Currently, our only income is commissions from Sunny Day, and then we hope to expand one day. So, financials consist primarily of a balance sheet and profit and loss statement. The accounting's base equation is assets equal liabilities plus equity. That basically means that for every debit to an account, there's a corresponding credit. So by the time you're done with your balance sheet, no matter what, your assets will always equal your liabilities plus equity. If your assets do not equal the liabilities plus equity, there's something very wrong with your financial statements. Assets are the tangible and intangible resources of a company. So any sort of computer equipment our company is going to use, our telephone equipment, the building we're in, any cash we use to pay our commissions to others and employees, those are all assets of our company. The liabilities are a company's debts and other financial obligations, basically the money owed to others. So our accounts payable would consist of a liability, the loan for our building would be a liability, the payroll taxes owed at year end would be a liability as well. Our equity is the shareholder's stake in the company. It consists of annual net income or net loss and historical net income or net loss. Equity is what's left over after we've recorded all of our assets and liabilities on the balance sheet. Financial statements vary in complexity and content, so please consult your accountant to further describe accounts unique to your business or industry. Today we're going over a very generic balance sheet and profit and loss. There are many other accounts and situations that can arise. So on a balance sheet, we're going to start with our bank account balances. Now, what's interesting about bank accounts is the ending balance on the statement may differ from the ending balance in your balance sheet. And that's because there could be checks written out at year end that would lower the balance in your accounting software, or there could be income recorded on the balance sheet that was not processed by the bank yet. Now, with those two situations, you can figure out if your balance sheet is accurate or not by pulling up a reconciliation summary. The reconciliation summary will show you the statement balance and how we got to book balance. Prepaid taxes is a pretty typical asset account in the state of California because we always prepay the $800 for next year. For our fixed assets in Catching Rays Solar Inc., we purchased the building that we do business in, so we have that as an asset, and all of the computer equipment that we use in order to sell the commissions. Now, accumulated depreciation is what's known as a contra asset. So assets are typically a debit balance, but accumulated depreciation holds a credit balance, and that's because it is slowly expensing our building and computers. Because these pieces of equipment are used for a very long time, we do not want to take the expense all at once this year. We want to take the expense as the building and computers lose value over time. Then our last line is the security deposit we have with a storage unit or something else, basically some sort of thing that will be credited at the end of a lease term. For our liabilities, we start with our credit card. We have an open balance of $865 on this credit card by the time that our financials close on December 31st. We have one note payable, but as you can see here, we have a notes payable short term and a notes payable long term. Now these both are part of the same loan. The difference is we plan to pay off the short term portion within the next year, and the long-term portion we do not plan on paying off within the next year. A big mistake we see in these accounts is interest payments being recorded as principal payments. So basically the entire payment to the loan is recorded to reduce the principal balance. The problem that arises here is that we show off a loan being paid off, but we still have payments to make because there's still principal outstanding. As we can see here, we also have payroll liabilities recorded. These payroll liabilities are most likely our payroll taxes that we had to record at year end. Typically what occurs is the payroll taxes we report on our federal and state payroll forms do not match the book payroll tax expense because we still have a payment outstanding for the last payroll period of the year. So typically what accountants like to do is to add that payroll liability at year end in order to tie to the payroll forms that have been submitted to federal and state governments. The last section on the balance sheet is stockholders equity. We see that we have a paid-in capital account. This account was set up when Ray made his initial investment in the company of $10,000. We have an owner's draw account. This is money that Ray took out during the year from the company, and we see that he took $41,000. Now, a lot of people are confused as to what an owner's draw is. It's any time that an owner takes money out of the company. Now, I can take money out directly by issuing a check to myself, or it could be that I paid personal expenses out of a business account. Retained earnings is an account created by the summation of historical income and loss and historical owner's draws. And then our net income comes from the profit and loss statement that we're going to talk about now. And as we can see on this balance sheet, it's actually a net loss, not net income. So an introduction to the profit and loss. A profit and loss reports a company's net income for a given period of time. So we can run a profit and loss for all time, for this year, for this month, or just for yesterday. It all depends on what data you need from the report. Our typical date ranges are 1 month, 1 year, year to date, and year to last month. Comparing income and expenses to historical data can be a great way to tell a company's financial health. So if I want to see if I'm doing as well as I was last year, I can take my two profit and loss statements and compare them to see where I'm at with gross income, with my expenses, with my cost of goods sold, and see if I did something wrong this year or different, and if it was something different, is it working? So a typical profit and loss looks just like this. We see our commissions from Sunny Day Solar Equipment. We have our 1 month ended December 31st, 2019. As we can see, it was a pretty good month with us earning $14,798 in commissions. Then we have our total sales for the year of $136,102.02. Now, once we derive our gross income, we have to record all of our expenses flowing through the entity. So, we list them out here. And one expense that most people have trouble with is the depreciation expense. Now, as we talked about accumulated depreciation on the balance sheet, the depreciation expense is the corresponding debit to that account. So what occurs is, as our equipment ages, we record the depreciation on that equipment, and it takes it as an expense here. Now, a lot of people are uncomfortable with this expense because it lowers their net income in a way that they feel is fictitious. However, there is a method to this, as that expense would have been recorded in past years had we not recorded it as a fixed asset. So it's very important that we add that back here. Two accounts that your accountant typically tries to tie to outside documentation here are the salaries and wages expense and the payroll taxes expense. So at year end, if you see some adjusting journal entries, it's probable that they are for these two accounts. Some other notable reports are the general ledger. It shows how all the numbers flowed through the financial statements, and it shows all debits and all credits to all accounts. The balance sheet detail shows all the transactions that flowed through the balance sheet and doesn't show any profit and loss transactions. The profit and loss detail shows all transactions that flowed through the profit and loss and not through the balance sheet. The cash flow statement shows how changes in balance sheet accounts and income affect cash. And then the bank reconciliation summary and detail reports that we talked about earlier are helpful in figuring out why account balances differ from the bank statement balance. This has been our presentation on how to read financial statements. I'm your presenter, Ray Langley. My contact info is below. And just a quick plug, I am a QuickBooks Pro advisor, and I assist companies in learning very efficient ways to do their bookkeeping. So you could reach me at the email below. Thank you so much and hope you have a wonderful day. Bye-bye.